Hello there, my friends. Chris Marcus here with you for Arcadia Economics. And today, a video that I'm really excited to share with you. I think this may be the best one we've had on the channel yet, especially if you're into gold and silver, and you're probably not watching this if you're not. And also for some of you, I know are advanced traders out there. I've mentioned before my background was as an equity options trader. And a lot of this got started, as I mentioned in the beginning of the Big Silver Short book in that intro chapter. I'd been trading equity options, started learning about gold and silver in 2009. And so by 2010, 2011, had a bunch of equity options on GLD and SLV, which worked out a lot better on the way up than the way down. Although a large part of the reason of why I do this show and have studied silver so much and where this all began, fortunately, in recent times, I think it was last year, I checked in with my former futures and options teacher, great man, Ren Chen, that used to go speak at his classes at Rutgers after I became a trader. And when I laid the silver thesis on him, he was quite intrigued. Fortunately, he's a quantitative genius, as you're about to find out. And we really started thinking about how can you build a model so that if you do think the metals are going up, you can use options so that you get leverage, especially without having to use margin, and calculate a whole bunch of other really cool stuff that we've been doing. And I thought it'd be a great time to share. I was actually reviewing the call yesterday, and I mean, I'm a little biased, but if you like the show, I think you're going to love this. Quick disclaimer, this is by no means licensed financial advice. This is highly risky, and please, unless you're a sophisticated advanced investor, don't go out and do this. Talk to someone who knows about it first. Partly, we are going to start doing some consulting. So if you do need help, we will be making ways to do that. Today, though, is just really an introduction to what we're doing. But I do want to be clear, I think buying silver bullion is a much different risk than you have mining shares, options, all sorts of different things. So I just want to be clear about that. I'm not trying to get anyone in trouble with their trading, just some ideas to use responsibly. So with that said, disclaimers out of the way. Hopefully that's clear. And again, last note to keep in mind, this was recorded, I think back in December. So some of the dates or prices may be a little backdated, but you'll get the concept. Also get the idea of some of the things we'll be doing. I'll be checking the comment fields here. So if you have any ideas or ways that we can test it to break it and see so it's as foolproof as possible. But essentially, if you do think there is a big move coming in the metals and you're somewhat sophisticated and have used options before, I think you're going to like what we have here. So here we go.
Let's do that. Yes.
Yeah. Well, I'm darn glad you're here. And we have James, Matt, and Mike, three brilliant investors, good friends who are going to listen, and perhaps at some point we'll take a few questions and see if we can come up with any ways to potentially break what we're building to make sure it's foolproof. And
sure.
Also get input, just different ways people would conceivably use it.
Right.
Makes sense?
Yes. Yes. So you take the lead.
What's that?
I mean, you take the lead. So
Sure. And do you have video today, Renra? This is, and I'm
yes,
saying
I do.
This is Renra Chen, who was my futures and options teacher at Rutgers well before I became an option trader, even thought to. But it was nice.
I found it. Hold on. I found the Zoom thing is new. I found this. Here we go.
There he is.
I finally found the button. It's hidden right on the left lower corner. So
yep, the start video button. So
yes.
Yeah, and he used to invite me to come speak at his classes back in the day. And anyway, all around genius. Can you tell them just a little bit about your background, so put it in perspective?
Okay. Well, a little hard to say because I've been doing a lot of stuff. Chris talked about it already. Mainly, I think my career has been teaching. So Rutgers 18 years and Fordham 11 years, almost 30 years now. I think during this time, I kind of working also on the industry, either in full-time capacity. I think that was 1987 to 1999. I took a 2-year leave from Rutgers and worked at Lehman as a credit desk quant, yeah, for almost 2 years. And then, and also from 92, pretty much nonstop till now, on off, as a consulting in many areas, commodities, equities, fixed income mostly, also assisting trading and also risk management. A lot of that's actually risk management, like JP Morgan, Morgan Stanley, UBS, that's more risk management responsibilities. BlackRock, Lehman, Moody's, that's more, Moody's is ratings, so it's a little different. BlackRock, Lehman, that's trading. That's about it. So what else? What else you want me to say? So it's a little. I don't know. My wife called this Rolling Stone gather no moss. So being all over the place.
So perhaps if we were a marketing team and we're summing that up, we'd say the smartest man ever to walk.
Oh, come on. That's not true. That's too much. No, that's not true.
Have you ever derived Black-Scholes?
Yeah, of course. That's kind of option 101 as a quant. Yes. Actually, we derive Black-Scholes in a number of ways. Actually, 4 different ways. The differential equation method, the martingale, the traditional statistics method. That's like an old-fashioned. And then the number 1, is a Fourier transform. So, so you name it, which one you want.
Yes, 4 ways of deriving Black-Scholes. I asked because I remember still being blown away in Susquehanna training back in 2006. One day they bring in this guy, Doug, and he started deriving Black-Scholes from the beginning of time. Yes. It was about, 60 to 90 seconds in when I just completely was overwhelmed. I mean, he was using notations that I'd never even heard of. You can derive it 4 different ways. So
yes.
Think when we think of whatever you would call what we're building here, the quant team online.
Yes.
We're good to go there.
Yes.
So Professor, I hopefully you'll be impressed here. I actually made slides. I did not finish all of the slides, kind of how perhaps whenever we're doing a formal presentation to whoever one presents such a thing to, but anyway, why don't we take a look and see what I got, and let's see here. See how this goes. Can you see the slides?
Yes, I can. The big silver short. Yes. Oh, yes. Okay.
All right.
A longer version of the Big Short. Yes.
Yes. Well, let's get. Oh. Yes, correct that one.
Thank you.
So again, I ask everyone's patience and forgiveness. I did not have appropriate time to build the model to scale. I guess I did technically, but anyway, we'll go with what we have. Everybody, can you type into the chat window if you have seen the movie The Big Short?
Yes, I have. Actually, I read the novel first. Oh, chat window. How do I do that? Okay.
So there's a button that says, it might say more depending on where your screen is, but
lower left is mute and video, and then lower right is leaving, and then on the right is all the people. View options on the very top. Oh my God, this is really tiny. Hold on. Oh, it's gonna hurt my eyes. Hold on. Jesus.
All right, and thank you all for participating. I'm learning to use these in group settings, so I appreciate that. Mike, Matt, and James have seen The Big Short. All right. And Professor Chen has seen it, even if
Yes.
we'll figure you can keep looking for a chat window.
Yes. Jeez.
It's probably, let's see, someone, there's a bar at the bottom of mine
Or
where
at the
it says
bottom.
mute, stop video, new share, pause share, annotate, remote control, and more. Might be in more.
At the bottom is record, chat, share, participants, and invite.
Although it's not incredibly important that you find it now.
Okay.
Although perhaps I think what stands out to a lot of folks, myself included, is that we saw something get massively out of line. We didn't know, or I didn't catch it at the time, but the folks who realized the Big Short was a bubble, or that the mortgages were a bubble, they knew there was something off. They didn't know when it was going to go. Interestingly, even when it did finally begin to break, because the banks are involved for various reasons where rules can change, still took a while even after that. I mean, the bonds were going bad, yet they weren't getting paid on their insurance. But something that you can plan in advance for. I guess anything that we know in advance can be good because we know it in advance. I'm going to do a quick review here. So just to put things in perspective, silver hit $50 an ounce in 1980 and $49 in 2011. And it's back down at 17 bucks or so since then. Now, I would imagine a lot of people think, well, the Fed tightened and this and that. Although you can see this is the St. Louis Fed adjusted monetary base in 2011. It looks like about 2 trillion, or I guess however, or 200, this is in millions of dollars. Forgive me if I don't have this scale, and there are perhaps even better measures of what's the true monetary base, but you can see where it was in 2011. We're basically double that now. So the idea that money has come out of the system, this chart disputes, let alone comparing it to where we are we're in 1980. If interesting with the Hunt brothers, I find the story a little different than we were told. And again, really, that was actual physical demand. Someone was putting up money and margin, but keep in mind that the market broke when the margin requirements were changed. So similar to our friends in the Big Short, something to keep an eye on, that you can win yet still not win. So again, here's another chart. We look at total assets of the Federal Reserve, well in excess of the money that was in there in 2011. And I would say, based on the fact that we have daily repo lines, I think we'll see that get bigger, let alone that there's a missing 21 trillion that no one likes to talk about. Renra, have you heard about this, that there's a guy who has audited some of the government financial statements, and they've come away with $21 trillion of undocumented adjustments?
Jesus, my God, no.
Now, I had a guest on my show who said there's only $14 trillion of money,
Goodness.
and the military has lost $21 trillion. So my guess is that whatever amount of money we're told there's probably more out there. I mean, if the Fed numbers here are accurate, that'd be probably the first thing they've ever told us truthfully. So, whoops. Well, this slide isn't quite centered, but interesting note from when I talked with Jim Rogers last year. I love that quote. When people lose confidence in government, they always buy gold and silver. We now have Trump running against Joe Biden for president, while Eurozone melts down. If there's ever been a time when there's less confidence in government, I'm not sure So we'll see if Jim is right. One quick side note there, interesting to note, this was taken from today, where palladium is 1982. About to cross 2,000 bucks, I would imagine. Interesting, has more than doubled in the past year, amidst what I understand to be a structural shortage, because at the end of the day, what we're talking about here are commodities that are actually used. It's not like Microsoft has X number of shares and you rehypothecate it and tell 5 people they own each one. We're talking about commodities that go into products, small markets, so it doesn't have to be, something everyone in the world is using, although silver also fits that bill. But there are some, including myself, who wonder, could a failure in palladium make people realize, wait a second, perhaps other markets are leveraged? We'll take a quick guess at some of the numbers. So perhaps I'll arrange my slides in order before next time. But here we see silver mine grades plummeting, less silver coming out of the ground. Also the deposits, most of the easy stuff has been found. I heard a guy talking yesterday about how one of the things is when silver came down from 50, that forced a lot of companies to improve their balance sheets, but also meant less exploration, and they were selling a lot of forward production. So I continue to hear from the folks I speak with in my own research that the easy deposits have been found and there's less of them now. This one's quite beautiful here. From 1962 to 1968, the average penny silver stock moved upwards over 150 times in price. One went over 1,000 times due to a mere doubling of the price of silver when it went from $9 to $18. All right, folks. So a quick note from your editor here. If you're looking at that chart and saying, gee, I don't remember silver going from $9 to $18 in 1962 to 1968. Well, that's probably because you're a little more careful than I am. And when I was pulling that up, I thought it seemed a little weird, although I did not properly do my checking because I had the inflation adjusted button checked here, which is why you see those prices. So fortunately, as my friend David Jensen, who you may have seen on the show, pointed out, here 1962, if we go to January, we see $1.09. By 1967, $1.30, then jumps quite a bit here. Let's call it 250 is the peak I'm getting on this chart in June of 1968. Not surprising, you had Vietnam War going on, a whole bunch of other stuff. But anyway, just wanted to make a quick note there. The price did not double from 9 to 18, but what you're about to see was what happened in response to a price move of 109-ish to about $2.50. Professor, how much do we win if we have nickel options on the silver miner that goes up 150 times?
Oh my God. Wow.
Can you calculate? I think even despite all of your decades of quantitative training, that might be the number that's bigger than you can calculate.
Oh my God. Never be able to do something. This is going to be out of the decimal range.
I might add that there's a guy named David Morgan who's known as the Silver Guru, and he's mentioned a couple times there's one stock in particular that no one knows about that maybe perhaps would be one of his candidates for this. Fortunately, since we're friends and I'm a Morgan Report subscriber, we'll be able to dig into that. We also have access to experts like David, so people who actually have been following these stocks for years or decades. Again, if you had to pick one advantage, it's maybe all the people that we have access to, whether it's you, the folks on this call, the guest on the show. But perhaps you can show some quick numbers at some point of what happens if silver goes to 30 or to 50, and then let alone, you know, if you have a minor, like if First Majestic is $11, so if it went up 100 times, that would make First Majestic an $1,100 stock, right?
Yes.
So you can buy the 25 strike for a nickel. It might be worth infinity.
Something like that. Yes.
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 Fortunately, you're the genius you are, so you can put some precision to my guerrilla math.
Yes. Yes.
Silver, above ground stocks, a mere fraction of global assets. I would ballpark above ground silver supply. I guess nobody really knows for sure. At 2 to 3 billion ounces, which means at 17-ish bucks, we're talking 30 to 50 billion dollars, which is a tranche of a CDO, of a mortgage bond. So relatively small. How much of that has been rehypothecated that would further dilute those numbers, God only knows. Of course, one of the things that perhaps makes this timely and better that we're doing now rather than 2012 when I left trading floor to continue thinking about this. You know, when the price is 30 bucks, I would say that there's still a lot of leverage. When the price goes below the cost of production, which is in one of our slides and we'll see, then you start seeing mines shut down, which top silver producers supply continues to decline, a trend that I can verify has continued. Here's David Morgan, the silver guru, in a chapter of the book we're getting ready to release here called The Big Silver Short. Get your pre-order copy now. David talks, I asked him, for every ounce of silver, with all of the short paper, because it's traded in paper, so you could have QE 5, 6, and 7 an ounce today, but if someone keeps shorting that, and David said over 500 paper claims for each physical ounce of silver, and that's before adding in derivatives.
Wow. Jeez.
I love when you do that.
Goodness.
Primary silver producers, most profitable mine closed indefinitely as reserves depleted. So this one has the reserves depleted, but I'm sure anyone who searches for silver supply on their own and doesn't take my particular quotes will find a lot of similar results. All-in sustaining cost of primary silver producers. So we see some are average 13.55. Endeavor silver above that. So when silver was $14 or $15, Endeavor silver was paying the world the opportunity to spend all their time to lose money going out digging for silver. So perhaps another way of saying there is a floor to this. You can suppress markets, and maybe even like gold, and you could make a case is somewhat immune where, I don't know, if we get less gold and, you know, people buy less, then you're okay. Whereas silver, you have this large industrial component that at least the Silver Institute's numbers showed a deficit in 5 of the last 6 years already. Interesting if you actually look at inflows into ETFs, and also mint sales show record demand actually over the time when the price was declining. So, I mean, yes, can someone stuff the price lower by selling paper that doesn't exist? You can, but the more that you do that, you're pushing the beach ball further underwater. Does that make sense? Because then people stop. I mean, you could have more silver supply right now, but it might cost $20 or $25 to do it. So the longer this goes on, the more these numbers get stretched. And so there is a floor, which is why what we really want to do is hedge out, one of the things, hedge out time risk. Last interesting thing to think about is how many people actually own silver. Even when the price went to $49 in 2011, I wonder, even back then, I had some silver. I would talk about it a lot on my trading post on the New York Stock Exchange. I don't know anybody else that I met in person that owned physical silver, let alone if the CNBC audience starts buying silver, you know, or if we even return to 1980 levels. Silver, I believe, is one of the only metals below its 1980 high. Seems kind of unusual. So anyway, Mr. Chen, what we are doing with all this, again, I'll clean that up a bit so that as we perhaps do this again, you have all these things lined up. But
Right.
I guess I need to hold on, new share. There we go. So can you see my Google document now?
Yeah.
So I think everybody's heard this example, but in 2016, silver went from $14 to $20. First Majestic went from $3 to $18. A $6 move. So, because again, let's say your cost of production is 14 bucks and silver is $15. And you got a $1 profit margin, right?
Yeah.
So if silver goes from 15 to 20, it's gone up 33%.
Yeah.
But if the margin goes from $1 to $6 because now it costs you 14 bucks to dig it out of the ground, you're selling it for 20. So your profit cash flow in a very crude way goes up 6x on a 33% move in the underlying.
Mm-hmm.
So now actually is interesting to think, when you have cash flows like that, if you have $50 silver, what the cash flows would be. Of course, what is further a nice derivative that perhaps since what was the thing you said you modeled? Swarm theory?
Yeah, kinda. Hope it works here. We'll see. Yeah. Basically,
Although is interesting because
speculation gets more severe. So the price effect is it's more severe. Yes.
So because there's what the cash flows might value it at, yet realizing the price is going to go to where people who know even far less about these cash flows or the future price of silver might be speculating on, although it's nice we can model that out as well.
Yeah, yes we can, yeah.
But I believe earlier so again, we saw that play out when silver went up $6. First Majestic went up 6 times. So actually very similar to those exact numbers.
Yeah.
So Chris was hoping for a repeat of that this year. And we actually did see silver go up from about 14 half-ish to 19 and a quarter. So almost a $5 move. First Majestic doubled from 5 to 11 and change now. Of course, I bought the 11 strike instead of the 10 strike, which would have perhaps made other things a little simpler and ideal. Yet partly the essence behind that is that I believe I paid a dime, maybe back in January. The stock was trading five and a half, let's say. So paid a dime. And let's say you had gotten the same and gone back to 18, and that's the 11 strike that you paid a dime for. We'll leave aside selling it early or early expiration or anything like that. But if it finished at 18 and it's the 11 strike is worth how much?
Wow, $7 right there.
Right. So if you paid a dime for it, that means you got a 700 to 1 multiple, right?
That's exactly right.
Um, wow, that's even bigger than I remember that one. Oh, wait, no. We got
70
a
times.
70 to 1 multiple.
70 times, yeah. 7,000%. Yes.
So let alone, my premise is that I've spent the last decade trying to see if there's something I'm missing, where if silver went to 49 bucks in 2011,
Mhm.
the only reason it went lower was because a bunch of paper was hammered, and but if the true demand was higher than that for actual silver, and that's before anyone actually owned it, I've always kind of seen $50 as a floor whenever this is unwound, whether it's tomorrow or however many years it takes for it to happen. So let's say that I got lucky and in my 1 year window, I paid a dime for those and silver went to 50 bucks. Now, I mean, it's interesting that you could be conservative and say, let's say First Majestic went 1-to-1 with silver and ended somewhere around 50, even though we saw when silver moved at a 33% move that was $6, that First Majestic moved 6x of $15. So I guess it'll be fun to find out, but would you agree that there's a case to be made that if silver went to $50 tomorrow, because and it was because the world was realizing this incredible leverage, and that there's simply 501 claims and people are trying to buy that back, it's at least possible First Majestic could be $50, it could be $250. We don't really know yet. If we mapped out the cash flows, we could probably find out. But again, just based on what we went through before, you could say that a 1-to-1 ratio would be conservative.
Right.
So we have a bunch of factors at our side. And the thing is, okay, maybe it doesn't happen this year. Oh, wait, well, actually, let's finish those numbers there. So let's just say that silver went to 50 bucks and First Majestic went to $51, which again, a case could be made that that would be a conservative price for First Majestic, right?
Mhm.
So if that, in that case, the 11 strike call would be worth $40, right?
Something like that. Yeah. 39. Yeah.
If you paid a dime for it,
Jesus.
it would be giving you a 400-to-1 multiple.
Yes. Yes.
You put $1,000 into those options, and you hit it in that window. You have $400,000.
Yes.
If you're able to buy them for a nickel instead of a dime, that would give you an 800-to-1 return,
Yes.
right?
That's correct. Yes, that's correct.
So
That's correct.
let's say you got it for a nickel and you got 800-to-1, but it doesn't happen in the first year.
Right.
So you pay another nickel, so
Right.
you're back to a dime. So essentially, you could say if you're able to get them for a nickel, and even if it takes 2 years, you're still back at 400-to-1, right?
That's correct. That's correct.
So let's say even it takes you 4 years. So instead of a nickel, you're 20 cents, you're still at 100-to-1, right?
Correct. That's correct.
So
That's correct.
now we know we can get a nickel. I mean, if you go up to a high enough strike, there's somewhere that you're going to be able to get a nickel, right?
Right. Right.
Or if you do, again, the type of thing that we can look at is, is it better to do a 1-month option and then roll it over frequently, or to do a 1-year option and roll it over
That's
less
correct.
frequently?
Exactly. Yes, exactly. Yes. Yes.
We want to build in something that, I mean, I think we've all, you and I have already mapped out numbers where you could have this on for 20 years and you'd still be getting a multiple. There are ways that could be tweaked further. Some people like selling puts on some of these miners at a level where it's like, all right, if the stock goes down to $4, And if these guys were liquidated today, there's $6 of metal sitting in there, where in their mine. So, you know, do you sell puts and maybe 1 out of 10 times you get assigned and you're buying the stock below its intrinsic value and you have some capital allocated for that? I've seen a webinar where these guys talked about doing it on takeover candidates. I think I almost had a slide ready about that, where I continue to hear that basically for a lot of these bigger companies, they have commitments of how much metal they're supposed to deliver that you're not going to be able to deliver. It's more than you can go out and find. And again, have some folks I've talked to that seem to know it better than I do that say they're basically going to have to be buying a lot of these smaller ones. So again, perhaps a thing that can be modeled where, I mean, essentially, if you were buying your nickel options and selling nickel puts and doing it cash neutral, you know, then theoretically you could put it on for infinity, and then you'd really just want to map out whatever cash requirements you have so that when you do get assigned on X out of Y iterations, that you're, I mean, if we even got 51 to 49 odds on a fair coin flip, we can structure our bet so that there's not a probability that we win. It's the math is guaranteeing it, right? Because if you do it small enough so that the math works in your favor, versus what we'll avoid is that even if something is a 99% favorite to occur, if you bet your entire bankroll consistently, you are mathematically guaranteed to go broke, right? So, you know, and these are the types of things that we've talked about and started looking for, where, you know, what is the best way to essentially hedge out the time parameter as much as possible, because we have, similar to the guys in the Big Short, we have something that, you know, again, low cost of production, that it's like either different than gold. If we don't have the silver, it's like our choices are either stop, okay, maybe we'll stop using computers and electronics, or if, you know, you keep the pricing the way it is, like the price is going to have to go up if you want people to go out and dig the stuff up. The timing is the key variable. I would say some factors going in our favor are that when I left the floor in 2012, I was stunned it was going on then. And I would say there's a consensus in the silver community of folks who study this that if you'd said the silver price is below $20 in 2019, almost 2020, I would not have believed that possible. So I always factor in really the short case for pricing, ways the rules of the game can change. You know, I can't find fundamental reasons that, aside from, you know, they can write more paper. I mean, we now have a federal investigation that has confirmed what's been going on, yet it continues. So in either case, Professor and I have been building a model, and perhaps I can introduce some of the variables we've been looking at, and then I'll let you comment. Open interest, certainly one we'll look at, has a good correlation. You see when banks get really short, you know, the open interest higher. The actual bank long short position, we could have a fun time looking at some of the synchronicities there. My understanding is that the banks are well versed in technical theory, so are basically gaming a lot of what these guys are doing, the chart readers, and they know, hey, when it makes this pattern, they're going to do this, and they're sitting there fleecing them for the better part of the last 30 years, which is difficult to imagine. I believe that's how it's been going. We have the Fed announcements, money supply stuff. Be interesting. Maybe we can find something there. I've even stopped paying attention to some degree. I mean, last week the Fed paused and silver spiked up. A couple times before that, when a rate cut wasn't fully priced in, they cut rates and silver got destroyed. We're going to look, and it's great to have input from what others might conceivably think of, because at least the typical things that you would think, it's like I could tell you what the Fed announcement is. I'd be like, all right, there's going to be a surprise 100 basis point cut. You'd say, all right, well, I'm going to buy silver because it's going to go up, and you'll see it get smashed. My guess is that if whoever does such things were in the room and answered honestly, is that intentionally gamed? I would guess so. But anyway, we're going to put some sophistication to it. Supply and demand news. Interesting. There's not like a stock where Microsoft says X and but any supply and demand news we have, or fundamental news. And the last one I skipped over for a second there is the option expirations. An interesting one because, in fact, we're no longer in complete speculative territory on that, because the Department of Justice, one of their guilty confessions they've received from JP Morgan trader, actually talks about how they were front-running barrier options.
I see.
So that, if you sell all of the, in silver, the $17.50 strike calls and all the $17 puts, you can move the price wherever you want. Take a guess where that thing is going to end up.
I see.
Which again is interesting. I talked with a guy I used to trade with on the floor. He had gone to trade sugar, and basically all the things I had suspected about silver, as he was telling me, he's like, it was so weird. Like every time expiration came along, eventually why I stopped trading was like, we'd always get crushed on that because we couldn't hedge things. And somehow it just always seemed to go to the most unideal place. And now we have court documents showing that it's not a complete coincidence. So, I guess in the end, we have a few things we're doing here. A, what's the best way to hedge out time risk, keep the return as high as possible? And B, what are the variables that drive silver? And with that said, I will now finally pause. I've been going long enough, but Professor, any thoughts there, my friend?
Yeah, like you and I, have talked about this for quite some time now. I guess, my view, my expertise here can, really help the strategy to be more optimized. One thing is hedging against time. So you just talked about it, in perfect way. Basically, should we do, more frequent rollovers, or we just buy a little longer ones? Which one is more worthwhile? That, of course, has a lot to do with what your forecasts are, right? So if your forecast is this way or that way, that changes a lot. So, and these pricing variables are important because they, so we have the basic fundamental analysis about the market. And then the leverage, I think, is really interesting here. Even though I dealt with commodities before, but never in this way. So you really opened my eyes quite a lot in this, because this is the first time you actually taught me that the stock of a mining corporation is an option on the commodity they're mining. So there's a floor, right? Anything has
it's like we're stacking it like 6 layers deep, where it
right. So yeah, I've never thought about it because when I was doing commodities, this is like a model review for Morgan Stanley. I was really focusing on the modeling part. I mean, they're using Black-Scholes and so on, which we will be as well. But they're really looking at seasonalities. How I'm not specifically precious metals. I was doing mostly, I think, petroleum and something else I can't remember. Maybe petroleum related, gas maybe. But anyway, so they were looking at seasonality and stuff. So I was aware of how that affect dramatically how pricing of options is going to be. But this is different. This is basically saying that the company's stock has a 6x leverage, which is about right because if anybody runs the Black-Scholes example, at the money option has about 7 times beta as the stock. So if you're an IBM at the money call, I think you know this very well. Right? I mean, so it's about 5 to 7 times. That's my kind of numerical experience. Of course, I don't have any real world experience, but this is sort of my numerical experiments. So your 6S is right in the ballpark of what my experience is, and then you have option. That's another, like I said, 6 to 7 times. So at the very bare minimum, you're talking about 50 times leverage. This is a very standard case. You're not even taking extra risk. The standard risk is already 50 times, 50x. So that I think it's pretty. I don't think anybody. I mean, in my this quant, I call myself quant area, have ever thought about this though. This is actually amazing. I mean, I've been dealing with option people for a very long time. You're the first one who actually.
Wow, I'm honored.
Wait a second. I said, what the heck? Were you first talking about this? What the? That's when I got interested. I got intrigued. I was initially collecting data to look at seasonality and stuff, basically from my Morgan Stanley experience. And see that. And the more you sort of gave me stuff to read, I said, just wait a second. This is not it. Really looking at these investment bank floor traders, they're actually doing a very different thing than we're doing here. I mean, I don't know what they're doing actually. Now that I have seen this, this such high level, I don't think anybody has. Definitely in my.
Do you feel? Don't worry about numbers, but intuitively, would you agree that there's a way in there somewhere that basically you could have this insurance policy on doing it cash neutral?
Yeah.
There's some way that you could hedge it out that you're doing it
right. You can
cash neutral so that it doesn't even matter when.
Yes, you can. But that comes.
It's like your own printing press,
right? But that has a little bit of let's talk a little more because I've never traded such things. I've never on the floor, so I don't really know how.
Although even what if I told you one of the people on our call today is a hedge book expert?
Oh, okay, that's wonderful. Because I don't because when you have cash neutral, execution is very important. You have to be able to execute it. Because this is what we call the gap risk. Once you have a gap risk, then you have to assess, will that risk come back and bite you? So if the gap is too big, how long can you tolerate the gap and stuff? So execution is quite important. Yeah, so I understand in theory the cash neutral thing makes perfect sense, but whether it can be executed, so that needs to be seen. Right. But otherwise, of course, yes.
From an informational standpoint, again, I mentioned earlier how it's like a lot of these companies they could be better than sliced bread, yet it's like even if some of these guys are calling me to interview them because like even if I want to go on YouTube or look about them, there's no one. It's just like nothing. Especially the smaller ones, you have the information barrier that not only are the banks not covering it, they don't even, there's thousands of these mining stocks.
Right.
And it hit me the other day because there's the CEO of a company that calls me and we talk quite a bit now. And I was asking him if he knew about this other company, and in a way. And I told him, please always only, I think we both get public, non-public information, but to the degree where I asked him about this other company and it was like, he didn't say anything not public, but I was able to infer, okay, these guys are talking about doing something. And again, I want to do everything completely legally. There's no reason not to. Yet the point I'm getting at is that in terms of the informational advantage, I'm interviewing the mining stock. Anyone who knows about it, I'm interviewing, whether it's the company. So just to the degree that, I know while some people want to talk about the efficient market hypothesis, could we have a massive informational edge in terms of knowing which companies are going to be taken out? I think there's few people in the world who could top that, not because I claim to be a genius, but because I talk to all the people that know anything about it. Or at least not every single person that knows something about it, but any particular element of this, I mean, maybe either know the guy or can call him up and see if he wants to come on the
Yes.
show and talk about it. Also, from being a market maker, I know the programming algorithm for the market makers. Then I can tell you, or I'll offer to bet anyone an ounce of silver that the guy setting the markets for SLV and these miners, I guarantee you he does not know that silver was trading below the cost of production. Because I was that guy. I had like 600 symbols, like half of them I didn't even know what the fucking company was. But you're just, now they will adjust it based on the order flow. And one thing that would be interesting to look at is that it seems like when you have a big move up in silver, that those upside calls get pretty jacked. Right now, there's considerably a bit. It's hard to find some nickel options on First Majestic. So again, looking at the vol surfaces of, I'll bet to some degree, maybe once silver moves up or these stocks gap up, maybe just have even some allocation that without any thinking or motion, just certain parameters, then gaps up, sell it, and then wait for the inevitable hammer down. In fact, I have a note here of a loop I feel I continue to notice because I've had these First Majestic Jan 11 calls for a while. We're getting close to January. Fortunately, there's other people involved in this who can teach me something about diversification. Is not my strong suit. So rather than betting the farm on something happening in the next month, which is not my edge, I've been trying to, sell off a chunk of this. So First Majestic keeps hanging out 10, 50, 11 bucks. So I would wait till a day where silver spikes up, the mining stocks spike up, and I put in my offer on the offer. But it's like, I could be imagining it, but I feel like there's several times I've done that. And if you have random variance, some days will drift up a dime or 15 cents. Some days will go down. But it seems like every time you have that spike up, it's almost like I've gotten to the point now where I'm like, I think we're going to see. In fact, I will say, I'll bet someone an ounce of silver, we see a plummet in the silver price this week. I remember asking someone about that because you would think if nothing has changed with the miner and the price of silver goes up or down, it would make sense the price of the stock would go up or down in correlation to some degree, right?
Yeah.
Yet things are a bit rigged, which we know they are. This guy was saying what he sees happening over and over again is that even though that's what you would think intuitively should happen, it acts in reverse. Whereas, so for example, today, some of the First Majestic was up quite a bit. I looked a couple hours later, was down. So maybe we can put parameters to this. Again, I do know of one guy that I think may know how to actually read even more clearly the fingerprints and say when X happens, this is when watch out, or So, maybe there's some stuff I'm imagining, but again, that we can model these things, I think is pretty fantastic.
Mm.
And how about, got a couple minutes left. I would like to keep this pretty close to an hour because I know everyone has things going on, but perhaps if we have any questions. Don't be shy, fellas. I know someone's got a question there. Matt, you got the floor, and go ahead, sir.
So you guys have built out a model here with pricing. It seems to be very convex because you're talking about the miners themselves as opposed to the commodity. I know that in your case, Chris, you have conversations with a lot of these executives at these small mining companies. I guess one of the things of placing these positions, but then actively kind of writing your own ticket, other than just derivative pricing and things, would be allocations to ETFs is something I would think about with some of these smaller miners. You have like the GDX, the junior GDX. I don't know if those are even, what the tickers are and things, but I know that's Van Eck. It seems like it would be a proactive thing to get them involved in those, because essentially, especially something relatively illiquid like this, if you proactively can work with them to be picked up, whether it's a stock index, that relative flow for their stocks would be a huge flow. I mean, incrementally to get into some of those ETFs. I wonder if that's something that you guys have in any way thought about. I know you have a lot of market contacts and different contacts throughout, the industry.
I had not thought about that. It's a darn good idea. I guess it was funny. I noticed I'd wanted to trade options on Silvercrest, which were not available. And then I actually did talk to some of their folks a couple of weeks ago, and was going to mention to them it'd be great if they can get them listed, which is actually very easy to do. They used to just come up to us on the floor, say, "Hey, can you list them on these?" And we'd price up a board. I mean, assuming there's nothing, if I call them and the guy's talking to me about, and I say, "Hey, it'd be good if you do this," and introduce them to the guy that, or whoever makes the decision on adding something, I mean, as long as it is not in violation of any rules, whether that in particular is something like that, I would say, yeah, the answer is yes.
Yeah. I remember having a conversation with a guy, this was like last year, and he was pretty interested in mining stocks, predominantly gold at the time. And he was talking to me, I never really looked into it, but he was talking to me about somewhat of a controversial situation that GDX, or maybe it was the junior miner ETF that they have, was going to start including mining companies that weren't necessarily gold or silver for the preponderance of their revenues. So if that's the case, and I do believe him, but like I said, I didn't look into it. I never really allocated to this. It seems as though there would be a path to at least catalyze the discussion with those executives to say, who can we talk to get us involved there?
Yeah.
I know. Yeah.
I am quite confident that I think you've experienced it to some degree and would continue to find it to be the case that it's like the more you research, the more you'll sit there and be like flabbergasted where thinking, all right, I thought this was out of line before. Then, I mean, we didn't talk about how one of the main counter arguments against gold and silver traditionally has been, well, it's just a rock that sits there. You don't get any yield, let alone now we have negative yielding junk bonds. So compared to that, plus QE on the way. So, I mean, I agree with what you're saying, Matt. And that's, again, another one of the advantages where it's like there's just one factor after another. Really just, the unknown is the timing, but I don't And that's why when you can hedge that out, it really makes things interesting. Any other questions from our audience today? Mike, you got the floor.
Okay, I think I've came with a lot of questions and I'm leaving with even more. But in general, when I think about this topic, the big four areas that I think about is what are the instruments of choice? Meaning, do I want to do an individual stock? Do I want to do an ETF? Do I want to do an option on an ETF that's based on the commodity? Do I want to look at a futures option, which for silver is pretty out of the reach, I think, for all of us, but futures on gold options are not. Do I want to have a portfolio that's a mixture of these as opposed to just picking, the one stock? And then the next big question I have, of course, that we've spent a lot of time talking about is the time frame, and that's unknown, but the professor said, what is our forecast? Because that's going to affect our structure and how are we going to structure these trades. And then another lingering question that I have is, as I think about structuring a trade, we typically think of the classic price versus implied volatility relationship. So for example, as an equity rises, its IV typically falls. But that's because you have an instrument that's pretty much trading in an expected range, and there's really no surprises except to the downside. But in this case, the surprise is going to be to the upside, and you have so many suppressive factors on price for so long, it's a little bit hard to tell what that's going to be. So I'm just thinking there's a implied volatility explosion continually. And as price moves, I think we need to think about, do we need a dynamic strategy? So I'm not an Elliott wave theorist by any means, but I do see that price does move in waves, and it's stair steps rather than, straight move up or straight moves down. So do we need also, a follow-on strategy, because we might even miss that first move? So all of those are just the questions that I have in my mind, is really basically what are our expectations? If we can't forecast time, how do we have, a time neutral strategy? And then the implied volatility question is I think just going to be a complete unknown unless I'm missing something, because we don't really have anything predictable to base, a ceiling or a floor on these kinds of things. But more interesting, I think, would be the dynamic strategy of how do you play this out over time? Because it's great to catch the one move, but what if we were able to develop something that you could play over a longer period of time and pass on to our grandchildren?
Professor?
Okay. Yes, that's excellent questions, and also probably raise more questions. Yes, I can agree more. I mean, these are all very, very important concerns. Actually, it's been in my mind even the first day after Chris talked to me about this. Every single point is very well taken. I just would like to sort of emphasize something that I gradually have become more of a I guess as I become older, I become more risk averse. And on the other hand, I am not. This is contradicting, but I'm not afraid of risk anymore. I'm used to be like maybe I don't know, a couple of other things. But anyway, so there's a balance between dynamic hedging and profit making. Basically, the principle is just like thesis, reservation of energy. So energy doesn't go away, right? So risk doesn't go away. So this is also part of the major messages in The Big Short. So risk, just like energy, doesn't go away. It just becomes a different form. So the question is, can you take that form of energy? Can you take that form of risk? And people have different risk appetites, and some people have larger appetites in this, but not in that, and vice versa for a different person. So I'm grown to become more like we have to do dynamic hedging, but in the context of what is our major objective is. So when Chris talked to me about, we have 400 multiple, 200 multiple and stuff like that. So how do we utilize it? So that's kind of, what I like a lot, because I think the way I think about it is that how do we time hedge the risk? So not so much of the usual option dynamic hedging. So we try to reduce our contemporaneous risk, but really to hedge over time. So how can I sort of rolling over my options? How can I do a cash neutral strategy? So that's the way to hedge, but that's also dynamic. It's not like you do that now and you can just wait till 6 months after and collect the money. That's not going to happen. And somewhere along the way, if our forecasts start to change, then we have to adjust. So I don't have a good answer to this. I know I'm mumbling a lot, but I'm basically saying that I think those are all important questions that we have to sort of think about, and it has to be part of our models. So there's a lot of tools now that we can actually not rely on, like Chris didn't say it, but let me say it, inside information. So we don't need that so much, because we have a lot of information.
I think we have access to what would be the equivalent of that, but just through research and network.
Exactly. So we have information that's all legal and all that stuff, and we can actually sort of plow through the information. And there are tools now, machine learning tools now, that are very good to actually help us out. Like common filter, for example, it can filter noise out of information, so you can actually get real information as opposed to noise. So there are tools now that are like pretty fancy, I would say. Anyway, so that's something that we can actually incorporate in the models and do better forecast. Yeah. Anyway, I'm not sure I answered the questions, but just my response.
Mike, they're good questions. We're figuring that out as we go along. It's interesting, as you were saying it, a few different thoughts where, maybe there's a sweet spot on a put you want to sell. Maybe there's one particular miner that it makes the puts are just priced according to the Wall Street algorithm, but they're completely logical for whatever reason. And those puts are the ones you sell consistently to finance it, and you're doing the thing cash neutral. So one of the things that Ren Chen and I have talked about is also examining, when silver moves X, how do the different miners move? Does this one always go up? Does this one always go down? I'm not sure exactly how you'd bake it in, but the degree to which I would say that there are some market forces acting that over time will force the gold to silver ratio lower. So do you have some sort of hedge going on there? Questions to be determined. Again, fortunately, Ren Chen is brilliant and knows how to calculate all this stuff.
Well, I think it's certainly possible that in the end we come up with multiple great answers and multiple strategies, and
right.
can diversify by strategy and by instrument. So I think there's a lot of possibilities and potential there, and I'm excited to be a part of exploring not only the answers, but the questions leading to those answers. And by the way, Chris, I think SILV offered options for the first time last week. So
what is it?
Silvercrest, SILV.
Yeah, I saw they just added them.
Yeah, so we have new possibilities coming online, and probably we'll have more. So having a process in place to evaluate these, per instrument, per strategy, per timing forecast and expectation, just could generate a whole series of trading ideas and profit possibilities.
Yeah, and I think what'd be nice is that you have something that it gets simple enough where it's like any stock, or any view you have, it's like, all right, I think this, and it's like, all right, here's the right way to put it on. Because fortunately, perhaps I think these are all relevant questions, and although maybe one of the nice things is that I don't know if there's a way to appropriately put it in context, but it's so out of line that, even if you like, roughly hit it, so I mean, it's like, obviously these are good things and we can think about, but even if you didn't get that, it's like so out of line. In fact, it'd be an interesting idea to do a hedge fund where you just pick an asset class, ask 100 or 1,000 people if they think it's good, and if there's like stuff where 999 people think it's amazing, sell those, and whatever everybody hates, buy that, because
Right.
best, silver's worth whatever silver's worth, but it's priced by a voting machine. So the fact that right now I hear people go around and say, talk to funds, what's your allocation to commodities? It's not 10% or 5% or 1%. They say 0. So,
Well, we hear these educators that'll make claims that options are priced to perfection and so forth. But if there's a subsector in the marketplace, it's got to be this one where there's no way that they're priced to perfection, or will be once the volatility.
It's efficient market. I mean, you can't even get people to agree on the stuff that's already happened and how it should be priced, let alone what's going to happen.
Right.
So, let alone, again, it was really interesting to me listening to this thing last night where Rick Rule was talking about how, anything under, $100 million market cap, there's no coverage on. Yet I'm already going to these conferences. I can walk over the booth. The guy will sit there and he'll tell you anything you want to know. Yet there's, so it's a nice little subset. Perhaps one last final thought, and then I'll open for any other last final thoughts, and we'll wrap up. Did hit me. It's interesting that essentially you could take a variant of it and just use it inversely for shorting the stocks that are a bubble, because it's the same essential strategy, just it's like, so I mean, like, I think Tesla is on borrowed time. I think it's in Enron territory. We can discuss another time. Maybe I'm right, maybe not. Yet if I think that, how do I basically put a short on there where I've hedged out, essentially solving the investing questions that's existed since caveman days of how do you short a bubble or get or long the inverse of a bubble situation. And with that said, I'll say thank you for everyone who joined us here today. If anyone has any parting thoughts they would like to add, by all means, or else Ren, I will throw it to you.
Well, I'm okay. Thank you. Thank you much.
Yeah, thank you, Chris. Thank you, Professor.
Well, thank you, James, and
Yeah, thanks a lot, guys.
thank you, Matt. All right, fellas. Well, that's what we got for you today. More surprises in the near future, but maybe the fact it's taken this long is quite a blessing, and certainly is quite a subset. Factors to look over, and we'll see how it all goes.
That's true.
All right. So with that, I will say good night to everyone, and thanks for joining, and we shall talk again soon.
Yep.
All right. Bye.
Bye,
Thanks, everybody.
Thanks,
Bye.
thanks, everybody. Bye.
So there you go. I hope you enjoyed that one. If you do have any questions about what we covered, you can reach me at consulting@arcadiaeconomics.com. Thanks again, as always, for watching, and I'll see you again soon.